Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Bio-Rad Laboratories, ticker BIO. And over the next few minutes, I will be discussing both the valuation of this company and my thoughts on its value and my thoughts on its business quality. First up, this company is in the life science tools and services industry. Let's see what that means. So they manufacture, distribute life science research and clinical diagnostic products across the world. Life science clinical diagnostic. It develops, manufactures, markets a range of reagents, apparatus, laboratory instruments. And let's see, the diagnostic segments, manufacture, sell, and support test system, informatics systems, specialized quality controls for clinical laboratories. It sounds like an interesting business. Sounds like it could be high quality, but let's see what the rest says. Now, first thing that's immediately apparent is you have 20 straight years of profitability. That's always a strong sign when you look at a business. So I really like seeing that. However, the next thing I see is you've had declining margin returns on invested capital every year from 2002 down to 2016. That's very bad. It suggests that the business is not being well managed during this period, or they're facing increasing competition or something like that. So they started out in 13% in 2002, but by 2004, they were at 7%, no longer double digits. And then they were under 5% starting in 2013, and that continued all the way to 2017. Now in 2018, 19, 20, and 21, they turned the business around. And you see a massive change in the business in the last few years. And it's really hard to tell why that is. If I had to guess, this is maybe something COVID related, especially because 2020 is when you see really strong returns. But by 2019, they had also turned it around. So it's not totally clear what's going on here. Revenue of $2 billion in 2012, revenue of $2.9 billion in 2021. That's not a significant increase. And so something is going on here that's really hard to parse simply on this page. Now, operating margins have increased significantly, so that's a positive sign. But gross margins have been pretty stable around 55%. So, how they went from $5 per share in earnings to $140 per share in earnings is the real kicker here. So, I'm going to have to go to the next balance sheet and the income statement to really get a better look at this. If you're enjoying the video so far, please hit that like button. Please subscribe so that you can get uploads as I upload new videos on investing on different stocks each and every week, and you can continue to learn alongside me. So let's look at the income statement. This should tell us a little bit more about what's going on. Their operating profit has only doubled from 264 to 532. The numbers over the last few years are not real because you basically got this money from other non-operating income. $2 billion, $4.5 billion, $4.9 billion. So they're either selling parts of the business to other places or something. But basically, you look at the actual operating profit and it's not gotten that much better. So all of these numbers really don't make any sense. Shares outstanding have been flat over the last 10 years, maybe a little bit dilution. If we look at cash flow, we're going to see some stock-based comp. You see stock-based comp. There's not really much share buybacks or anything. Where is all that cash coming from? So other cash. Basically, cash flow from operations has doubled over the last decade, which is good, but all of this other is really the driver here. It's going to be very hard to analyze this based simply on what we see here because you're getting these investments that are uncertain and it's not clear what's going on. You're retaining these large amount of earnings. Your debt has gone down. Your PP&E has doubled over the last decade. Again, that's not a huge deal, but some investment that they made has worked out really well, and they're not seeing it on their operating income. So for me, this company is a pass because when you look at their actual operating business, it's been terrible over the last 2 decades. But the last few years, the non-operating portion of the business has done amazingly, and so it's skewing the return on invested capital. So for me, I pass on this business because it's very clear when you look at the cash flow statement. Here, real quick. You can see cash flow from operations of $600 million, but you compare that to a market cap of $15 billion. So 600 million times 10 would be 6 billion. So you're trading at somewhere in the 25 to 30 times free cash flow range for a business with very poor returns on invested capital. These non-operating incomes means maybe they own some other asset that's helping boost these recent numbers, but they clearly say it's not part of your operating income. So for me, I wouldn't count it as part of the core business. Core business looks poor. I would pass on Bio-Rad. If you like this video, please hit the like button. Please subscribe and ring the bell so you receive notifications as I upload new investing videos each and every week. Thank you for listening, and until next time, stop paying fees, start building wealth.